Good morning, everybody. Today I wanted to talk to you guys about principal and interest payments, okay? So hopefully this isn't going to be the most boring video that you've watched today. It might be the first video that you've watched today, but hopefully this is somewhat beneficial to you, okay? So, a lot of times my real estate friends will say, hey, you tell me how much you pay in rent and I'll show you a house that will be the same payments. Now I want to make a couple disclaimers here. Principal and interest payments is what I'm going to go over here as far as kind of laying out what that looks like for the amortized portion to give to the bank, which is, what you're obligated to do if this is obviously financing. So the PITI is principal interest, which is what's here, but the TI is taxes and insurance. Those are two things that almost no renter pays and that every homeowner has to pay. Now, you can pay the taxes a couple times a year and then pay the different types of insurance throughout the year, there are 2, 3, 4 times, whatever. However, I would say a majority of people, and you don't have to do this, but a majority of people, I think, lump them all and have the bank take care of it. So, service that they do, yep, we'll just make the payments, or your taxes, they just take 1/12 of it every month. Your insurance, they take 1/12 of it every month. So it's kind of all clumped together. I do that with my properties, and it just tends to be easier that way. But these numbers are not PITI, these are just principal and interest, okay? So as far as the taxes and insurance, for the taxes, that does vary. It varies whether you're in Harrisburg, Brandon, even Minnehaha and Lincoln County. It can vary based on where you're at. And, a $100,000 home versus a $600,000 home is also going to vary. I had heard at one point it was between 1 and 2% of the home's value, but again, that can vary based on quite a few different things. So it might be $100, it could be $300 or more for the taxes. So you do have to include that when you're figuring out what your payment would be, because that's going to be part of your monthly obligation or your multiple times a year, in my opinion. The insurance portion, I usually pay between $100 and $300 per property, depending upon what it is. Maybe like $150 or $200. Fairly close, I think, to within the range. But again, you have pools, you have multiple units, more liabilities, larger house to insure. That number could be quite a bit larger. Okay, so just to finish up with this, as far as the PITI, after these numbers, you may have to add $200 to $500 to even more, depending upon your taxes and insurance. So don't forget about those two things when you're calculating these. All right, so the monthly payment. This is really cool, guys. This is, home ownership at its finest when you are actually financing here. Okay, so a 30-year amortization means when they split the payment over the length of the loan, or the note is sometimes what they call the loan. Okay, so a 30-year note goes for 30 years. You can pay it off sooner if you'd like. You could get a 15-year note. Sometimes that's advertised as saving a little bit on the principal. I've even seen one gentleman had accelerated payments on a 7-year note. It's kind of up to you. If you did all cash, you wouldn't have a note, principal or interest at all, because you didn't borrow any. All right. So I'm not talking down payment at all. I'm not talking about any of those. It is just purely if you have a $60,000 loan. So if it's $60,000 house and you put 0 down, then that's what it would be. If it was, $100,000 and you put $40,000 down, 40% down payment, which is really nice, really, really big down payment, then you would have this for your loan. So if you had a $60,000 loan, then the principal and interest portion would be $300. There's lots of free online calculators. There's an app that I use just because I use it so much. Bankrate.com is a nice one online, as long as you go into the free calculator portion. I think just general Google has those as well. So then $80,000 is about $400. I wanted to point this out because this is kind of neat. If you haven't owned a home before, check it out. About a $20,000 jump is around $100 jump here. Want to take a minute to mention the interest rates right now. I am using 4.5 interest rate. I have had homes that within the last 7 years where the interest rate was 3.5%. Awesome. I have had a rental property, we're paying points and all that stuff, and it ends up being 5.5%. Okay, so those have been the ranges. Obviously, this depends on down payment, the loan product, your credit, borrower's strength, that type of thing. And also, I'm not sure when you're watching this movie, but right now, when I'm making this movie, this little video, interest rates are probably within the the low fours as far as average, but 3.5 to 5.5 is probably the window that a lot of people are in. Again, it could vary. That's why I'm using 4.5%. Okay, so look at that, $20,000 jump in loan. It's about $100. Okay, these are kind of good things to know if you're going to amortize for 30 years or if you're going to amortize for 20 years. It's good to kind of be able to see, hey, this home is $20,000 more than I thought. This is what I'm going to be doing. Okay, that's an extra $100 a month. Okay, and then you can kind of scale it out from there. So then we have $100,000 is $500, and then let's take a jump down here. So at $100,000 loan for 30 years at 4.5%, that's $506. Okay, so about $500. Let's double that. All right, so 200,000. Look at this. 1,013. Okay, so really you can kind of get an idea. So for every 100,000 you borrow, it's an extra $500. Okay, so you guys could say, okay, well, what would a $500,000 loan be? Okay, well, 500,000 you could figure then times 5, because 500 for every 100,000, so $2,500. Probably a little bit more than that, maybe like $2,525. But so $2,500 is going to be around the range of the principal interest portion for a $500,000 property, okay, with these requirements. So the reason I'm pointing this out is because if you haven't actually looked at these are really good to kind of, be playing with the different numbers. Okay, well, what if I did a shorter interest, a lower, what if I refinanced and got a lower interest rate? What if I put it on a 20-year note, a 15-year note? As far as the interest rate or the amortization, so I personally love the 30-year financing. Stretching it out that far means the monthly payments are going to be lower. It does mean the payments at the beginning of the loan are, a lot of it is interest, and then at the end of the loan, a lot of it is principal. And I'm not saying that's good or bad, but what I do like is, let's say I have the $500 that I have to pay every month because it's a 30-year, but I'm comfortable paying $800. So I pay $800, and I could figure that out, and maybe that'll be paid off in 21 years. Okay, so it's like a 20-year loan or something. Maybe I'm really comfortable with that. But then if something happens as far as, a family member gets ill or something happens with my job to where the income or the expenses kind of shake up a little bit in life, I like having that comfort of the lower payment to where I have been sending $800. Now I drop it down to $500, and that $300 can help me through this little life situation. So I do like the flexibility of that. Again, complete personal preference. Talk to your banker. Just trying to stir up some ideas here of what you guys might be thinking about. Okay. So the other thing that I want to mention here. So we got 400,000 all the way down to around $2,000 a month. Again, then you'd have to plug in your taxes and insurance. The last thing here is the $1,000 a month principal and interest. So a buddy of mine, he's currently renting, and he's paying around $1,000 a month in rent. Okay, he's getting a pretty good deal. It's a really nice place. That $1,000 a month, him and I were talking about this, and he said, I don't even know what it would cost for a $200,000 house. And we said, well, $200,000 would actually be right around $1,000. He got super excited, and he said, hey, I can afford $1,000. I can't afford much more, but I can afford that. So why am I renting? And I should buy. And as a real estate agent, I would love to just go quick sell them a house. That would be so great. I love putting people in houses. But my fiduciary responsibility, I have to put his interest above everything else, above my interest even. Okay, so even though I would love to sell him a house, because I just love selling houses, it's super fun. I need to stop and I at least point out some other things here. The principal and interest, yes, is $1,000. So let's say his rent is $1,013. And I think the home ownership ideal of, over 5-10 years, it might have gone up in value, and part of that $1,000 is paying it off, and it's your own, and you can force equity and maybe rent it out later, and low barrier to entry. I love owning a house, but as far as affordability, that part of the conversation, I need to point out to him that you're only paying electric at your apartment. When you own a home, you're paying water, trash. You have to take care of the lawn and snow, or pay HOA fees that do that. You may have a gas bill. So you might have, 4 to 6 other utilities, which might be an extra $200 to $500 more a month than you're used to. Okay, obviously that can vary a lot, but it is something that he does need to think about, and you can try to verify some of those expenses and get some averages. But then also the taxes and insurance. If it's the house across the street, he can go look it up on the county assessor's website and see what the annual taxes payment would be. Divide by 12 to figure out what he would be having to pay. $100, $200, $300, $400 a month for taxes, and then insurance. He could maybe get a quote on an average there too. Okay, so really, if the most he can afford is $1,000, it would not be in my best interest to put him into a $200,000 house. Maybe a cheaper house, okay? But a $200,000 house that might be the max of his budget. Now, what if he says, actually, I'm going to be getting a raise and moving in with my significant other to where we're going to have $4,000 a month. Okay, well, now you're actually saying that if you had taxes and insurance and utilities plus that $1,000 a month, it would be still affordable. Well, awesome, that is great. I'm going to have you go to a couple bankers and get some pricing, that type of stuff. Obviously, this whole conversation can happen with a banker. It's just something that I like to throw around to people. If you haven't thought about buying a house, if you're looking at different price ranges, how much that jump is, the amortization, and then also just remembering the extra costs with home ownership. I think those are important. Thank you guys for watching. Hopefully it's somewhat valuable. Go ahead and comment below, and you guys have a great day.